I think one of the best things that you can do for yourself and your personal finances is starting a whole life insurance policy as quickly as possible. It begins your life with a forced savings plan and helps you build your safe foundation of money so you can be protected against emergency and be prepared for opportunity. Now, there are some people out there, Dave Ramsey, that says that whole life insurance is a terrible place to keep your money. So in this video, what I thought would be fun to do is to put together a video comparing a whole life insurance policy and a savings account, apples to apples, side by side, and let you make the decision for yourself. So if you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video, because I got videos like this coming out every single day. Let's get into it. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and we are talking about whole life insurance as a savings account today. A lot of people will say whole life insurance is a bad place to put your money. I'm here to tell you it is probably the best place in the world that you can keep your safe, liquid, accessible capital that you're looking for. I'm speaking to all you entrepreneurs. I'm speaking to you real estate investors. I'm speaking to you folks that have families that just need to have an emergency fund. I'm a big believer. One of the biggest things that we can do to increase our financial security, which will increase the results in our financial life, which will increase our behavior with money, which will improve us and help us grow to become who we need to be to get to where we want to be. Ultimately, that's what this life is all about. It's about the journey that we are on to get to where we want to go and to live the life that we want to live. And ultimately, money is a tool to get there, and your relationship with money is going to help you get there faster, or it's going to keep you from getting there at all, potentially, right? Which is unfortunately the way that we are in this country, in the United States specifically, but pretty much all the way around the world. People's poor relationship with money and poor understanding with money is holding them back. And how to save money versus invest money, understanding the difference between saving and investing is a huge thing. So for this video, what I thought I'd do is I'd get into, all right, if you got to save money, which I think if I were to ask most people, and this video is for you if you can answer this properly. Do you believe that you need an emergency fund? Do you believe you need an emergency fund? If you believe you need an emergency fund, the next question is, how much money do you think you need inside of an emergency fund? A lot of people would say, I need 6 months. And they say that because they've heard it somewhere, probably from Art Williams or Dave Ramsey or some other financial guru, right? And my question to you is, why do you believe you need 6 months for an emergency fund? 6 months of income for an emergency fund. Most people would say they need that because they heard it somewhere. Most people would say because they feel like they'd be fine. If they could last 6 months, they'd be able to get back on their feet and it would be good. I'm here to tell you that when the economy gets bad is typically when we need that emergency fund the most. And during times of challenge and hardship in the economy, the average time it takes to find a job is about 1 month for every $10,000 of income you earn. That changes and varies sector by sector, industry by industry, but it's something that is that to be considered, right? So people who are earning $100,000 a year, that's 10 months to be able to find that job, if you can find it at all, right? And that's average. So I don't know about you, but average means there's some people are going to find it faster and some people are going to be a little slower. And my question is, how prepared for this are you? Now, maybe you make $50,000 a year, so 6 months might make sense. I would still encourage you to think that is average. And so think on the average side of this. But when we look at this, now we say, okay, yes, you need an emergency fund. You know how much money you want to save inside of that emergency fund. And my question is, what are you doing to do that right now? What are you doing to save that money inside of that emergency fund right now? That's a question. And are you putting it in a savings account, which is what most people do, because typically speaking, you got to put the money in a savings account because you got to have liquidity, use and control of that money. That money inside of a savings account is going to be liquid. The downside to it is that you're going to lose money to inflation. You're going to lose that capital because the returns that you get inside of savings accounts, they fluctuate greatly over time, but especially over the past decade, interest rates inside of savings accounts have been atrocious. Now, are they better right now? Sure. Can you get better rates if you put larger lump sums in? You can. There are some variables that come into play, but what I thought I would do in this video is just compare a whole life insurance policy to a savings account from a performance perspective, side by side, talk about the good, the bad, the ugly of a whole life insurance when utilized as a savings account, and then also talk about all the additional benefits that comes along with utilizing whole life insurance as a savings account. So what I want to do now is I'm actually going to share my screen here. So this is an interesting thing. So you can see here, this column right here is the premium deposit or the premium payment or deposit for a savings account, you could see. So what I did is I started with somebody that said, all right, like let's assume you have $30,000 already saving because you're of the mindset like, yes, I need to save, but maybe what I'm doing for saving isn't as efficient as I could potentially make it. So I'm open to looking at other ideas. And so let's take a look at this. So what this is saying is you started with 30,000, but now you have 50,000 sitting here, right? What we're doing is we're saving $20,000 a year every year after. Now, I'm a big believer that this is not just utilized for an emergency fund, this is utilized for an opportunity fund as well. And this is specifically applicable to anybody who wants to get involved in real estate investing, anybody that wants to get involved in starting their own business. This is an absolute essential. Now, if you are not interested, full transparency, if you're not interested in real estate or starting a business or anything of that nature, this would want to be scaled down unless you're a higher income earner, right? Like you would cut this in half, or like you would look at the numbers based on how much money you want to save for your emergency fund, and you would scale it back to get to those numbers as quickly as possible, and then you could scale it back from there. But if you are a real estate investor or an entrepreneur or desiring, aspiring real estate investor or entrepreneur, this is exactly the strategy that you can use to put yourself in a position to be better and to have your money leveraged more efficiently than putting your money in a savings account or putting your money in other financial instruments that lock your capital up while giving you guarantees. That's a challenge, because that's one of the benefits of a whole life policy, is that it's going to get you bond-like returns with savings account liquidity. And that's really ultimately what we're talking about. But as I'm going to show you here, you have to look long-term. Now, full transparency, I just went out 10 years and then I stopped payments, right? Because I wanted to stop payments and have that conversation and let people know you don't have to keep paying into a whole life policy. Unlike an index universal life insurance policy that you can never technically pay up and there will always be internal charges and expenses and fees inside of the policy with an IUL, with a whole life insurance policy, you can pay up the policy completely. And I did that in this example to show you what it would be like starting year 11, where you would never have another expense the rest of your life for it, and it would just be a bank account on steroids. And that is ultimately where we're starting. Now, when we go to year 1 here, let's talk about the downside of a whole life insurance policy as a savings account. Well, the downside is that you're behind the 8 ball, right? So you can see here that if the bank account value is here in column G, and the whole life insurance cash value is column E. Now you can see right here, I'm gonna just blow that up a little bit. 45,514. So you got 50,000 in contributions in premiums year 1, but you only have $45,514 of capital. That's all you have. Now, in a savings account, what would you have? You'd have 50,000, and you might pick up like a couple $100 in interest on that 50,000, but it's a rounding error at this point in time. So you're about $4,500 ahead in a bank account. So the downside to using a whole life insurance policy is if you absolutely need liquidity of that $50,000 year 1, whole life insurance probably isn't good for you because you're going to lose some liquidity of that money. Now, I would argue that if you're thinking long term, that loss of short-term liquidity is not the biggest deal in the world when you look at the long-term benefits that I'm going to go over. So stay tuned, because I'm going to go through that. But right out of the gate, one of the benefits immediately is that $4,500 loss of liquidity is going to pick up almost $900,000 of life insurance, right? So, if you have business partners, if you need a key man policy or key person policy for your business, that would be a huge benefit. Maybe you just have a family and you want to make sure that your wife and your kids or your spouse are more protected. That could be the deal as well. But it's really important to realize that there are other benefits that come with whole life insurance. The thing that I didn't talk about yet either is that you have living benefits inside of this policy. So one of the things to note is as you build the cash value inside of this policy, the living benefits, meaning if you become chronically or terminally ill, you're diagnosed with that, you have access to the death benefit while you're alive to handle and control your own medical directive. It's one of my biggest passion points for why it's so important to have a policy like this. It's why people like Dave Ramsey miss out on that conversation, because if you do a term policy and you get to retirement when you need that kind of protection most, that long-term care, that chronic kind of care policy, it's having access to that is huge, right? And it can make a huge difference in your life, and it can make a huge impact on the trajectory of your family, and the financial trajectory of your family. And so it's a huge deal that most people miss out on, but it starts literally day one, and that's a big deal. So that loss of $4,500 of liquidity gets you living benefits starting year one, and it gets you this life insurance. So you're a little behind. The life insurance company equals, here, let me just do this, that minus that. Yes, there we go. So you can see right away that you're behind, and it is what it is. Like I'm not gonna sit here and try to blow smoke at you and tell you that whole life insurance beats a savings account right out of the gate, because the reality is it doesn't. It doesn't do that. It's not going to beat your savings account right away, and you've got to be thinking long term. Now you can see year two, you contribute $20,000. Well, your whole life policy is growing by nearly the full $20,000. It's like $19,700 or something of that nature. That's a really good thing, right? Like that's a pretty darn efficient policy. You're still behind the bank account. You're actually a little further behind year two, and that's okay. But now year three is when you start catching up, and you start catching up every year. And by the time you hit year six, the savings account, by the way, year six, your whole life policy ends up passing your savings account. Now, here's the deal. Not only do you pass it, now this is just looking at it from a strict cash to cash percentage, right? This is just talking about strict apples to apples comparison on liquid accessible cash. Now, year six, not only do you have more cash, but you're gonna be having your money inside of that policy grow faster than it's gonna grow, probably at a 10 to 15 or 20 times rate compared to a savings account. It's gonna grow from a cash accumulation perspective, but you also have $1.129 million of life insurance, right? That goes along with it. Now, Dave Ramsey is gonna sit here and tell you that you're gonna have, that the life insurance company is gonna scam you, and they're gonna keep that $154,000 and only pay you 1.129 million. Well, I'm gonna show you here. If you took 150,000 and you subtracted it off the 1.129 million, you're still $975,000 is the net death benefit after they keep your cash value. They do it like this because they pass that money to you tax-free. If you die and your money's in a savings account, let's say you had a $975,000 whole term policy, A, you're gonna have expenses for that term policy, and B, the term policy will be passed tax-free, but this $152,000 will have potential tax implications for your heirs when they inherit that money. And so this is why the life insurance company does it this way. It's positioned by Dave Ramsey and Susie Orman and people like that as a negative, but in fact, it's actually a real positive that is a leverageable tool. And this is one of the reasons, like, sophisticated wealthy people understand how money works, and they understand the benefits of this, and so then therefore that's why they own more of this stuff than anybody. But at the end of the day, let's just look at the numbers here, and the numbers are pretty straightforward. But the numbers are pretty simple when it comes down to it, right? So when we look at this, like, now let's go to year 10, right? And let's really look at year 10, where we got $263,000 versus $236,000 in a bank account. So we are $26,000 ahead inside of the whole life policy with our safe, liquid, accessible, guaranteed money. No other financial product in the world, not IUL, is gonna offer you these kinds of cash values, right? Like of cash growth and accumulation. It's pretty awesome when you look at that. Now you're also gonna have the death benefit. Now, full transparency, starting in year 11, I did what's called a reduced paid up. I did a reduced paid up because I said, hey, what happens if you wanna just stop paying? Once again, in an index universal life, you're not allowed to do this. You cannot do this. You can never fully pay the policy up. But you can see here with a whole life policy, I fully paid the policy up. So what happens is the death benefit drops. That's why you see that drops drastically in the death benefit. I had a 10-year term rider that allowed us to put this kind of cash in efficiently for the first 10 years. And then I reduced the death benefit, paid up the death benefit, got rid of all the internal expenses and insurance charges and all that stuff, had my $275,000 sitting here. That trumps the $238 that's sitting in a bank account. And what happens is I got an extra, whatever, 602 minus 275, got an extra $327,000-ish of life insurance to boot. On top of that, it's gonna be tax-free above and beyond my cash value. Pretty solid stuff. You can see just cash on cash, I'm $37,000 ahead. But then on top of this, you actually, depending on what company you go with, you can have access to these living benefits inside of this policy still. So that's why I call a whole life savings account a savings account on steroids. And this, when you look at this is as ironclad as any financial product on the face of the earth. And now, so I didn't go all the way out on this, but you can see I went to year 25. And if we just go to year 25, the whole life insurance policy compared to a bank account is about $245,000 of cash value ahead. You have the life insurance on top of that, and it becomes a no-brainer. That's if we stop funding it. So once again, if you believe in the need for safe money for an emergency fund, for an opportunity fund, I will tell you this, is that the biggest thing you can do to protect yourself, the biggest thing that you can do to set yourself up for success as you move forward in your life is to start a whole life insurance policy as quickly as you can. You're never going to be healthier than you are right now. We don't know what your financial situation is going to look like. They're way more flexible than people realize as far as this goes. Like for instance, I'm going to actually go back to this one more time. And just to kind of talk to you, out of that $20,000, that premium payment, it's flexible enough to the point where that could be paid at the minimum of about $4,120 a year. If you couldn't afford the $20,000 deposit for 1 year or whatever, you could pay $4,120 that year, or you could actually have the dividends pay your premium for you. You could use what's called a premium offset if you needed to. If times got really tough in year 4, 5, 6 or something of that nature, you can do things of that nature. It's more flexible, but this is why it's important that you work with somebody that really understands what they're doing. So if you're considering, should you utilize whole life insurance as a savings account, I would say just look into it. And there's no commitment for anything. I just reach out to our team, set up a clarity call. The link is in the description below. And one of our guides will just walk you through, and they'll help you understand like what this would look like in your life. They'll help you understand the best way to set up your financial foundation utilizing a whole life insurance policy. I don't know if you have nothing in a savings account, or if you have $50,000 or $100,000 or $200,000 in a savings account. The more you have in a savings account or safe money or even CDs right now, the more you should take a look at this, because starting with a lump sum can be, it basically puts this into hyperdrive and makes it one of the most powerful assets in the world that you can leverage in so many different ways. And it's too much to get into in this video. I don't want to go too long. The real focus is just saying, hey, when we think about safe money, typically people are thinking savings accounts and they're thinking CDs and things of that nature. And at the end of the day, I just showed you mathematically, factually, this is an exact real life case scenario, right? Like I just showed it to you apples to apples, side by side, what it looks like. And to me, this becomes the biggest no-brainer in the world. So if you have any questions, make sure, comment in the comment section below, set up a call with one of the coaches on my team. They'd be happy to walk you through it. And I'm, of course, happy to engage, have a conversation. If after you talk to one of my coaches, it warrants a conversation with me, I'm happy to hop on a call and help anybody with anything. I do my best to engage with every single comment, and that's it. So until next time, have a blessed, inspirational day. We'll talk soon. See ya.